Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Global Partners LP, and let me tell you, it's a bit like trying to understand why gas prices are always so high. You think you've got it figured out, then something shifts and you're back to square one scratching your head. Scrofted Courts, this is a Form 8K filing which companies use to report major events to the Securities and Exchange Commission. Think of it as an O or a Tata Boy alert for investors. The date to keep in mind is March 20th, 2025, because that's when the event we're about to discuss happened. Here's the big news. Global Partners, which is in the energy and convenience store business, has made some changes to its credit agreement. A credit agreement is basically a fancy way of saying loan deal. They've tweaked their existing loan agreement. This isn't just a minor adjustment, it's like remodeling the foundation of their finances. This is the 11th time they've amended it, so clearly they like to keep their options open. Scroll 11th Amendment amends certain terms and provisions scroll. So what exactly did they change? First, they pushed back the date when they have to pay the loan back. The maturity date, as it's called, was extended from May of 2026 to March of 2026 to March of 2026 to March of 2028. That's like getting a 2-year extension on your homework, giving them more breathing room to manage their debts. Second, they removed convenience store and related retail fuel facility properties from what lenders can claim if Global Partners can't pay. These properties will not be the collateral. A collateral is the security or guarantee. For a debt, it will still be a negative pledge for the lenders, meaning they still have right to it. Third, they changed the amounts they can borrow. The aggregate W's key commitment, which sounds complicated but just means a line of credit for working capital, is now $1 billion. The aggregate revolver commitment, another type of credit line, is now $500 million. Think of this as adjusting the limits on their credit for working capital is now $1 billion. The filing mentions that other terms of the credit agreement remain the same as in their last annual report. So to get the full picture, you need to dig into that report as well. A 10K is their yearly financial report. If you're super interested, you can find the full details in the exhibit attached to this filing.ked now. Let's zoom out and think about what this all means. This is a company that's managing a lot of debt. They are choosing to extend the amount of time they have to pay back their debts. Extending a loan is a good thing, especially if the rates are good. What this tells me is that they probably wanted to pay off the loan in the future in case there are problems. Also, the fact that they're modifying which properties the lenders can claim suggests they're trying to free up some assets. They are giving the lenders other assets instead of their convenience store and fuel properties. Maybe they have plans for those properties, or maybe they do not think they're good as collateral. I would say that it may be that they're trying to make their balance sheet better because investors look at the balance sheets of a company to make a decision if the company is good or bad. Overall, this filing shows a company that's actively managing its debt and assets. It's not necessarily a sign of trouble, but it's definitely something investors should keep an eye on. Scroll pursuant to the requirements of the Securities Exchange Act of 1934 scroll. And that's it for this edition of Corporate Decoder. Thanks for tuning in. If you found this helpful, please like, comment and subscribe for more deep dives into the world of corporate filings.